for more on today's broader market action, some of the selling that we are seeing across the board, we want to bring in Barrett Asset Management Chief Investment Officer Amy Kong. Amy, great to see you. So I guess just your takeaway from what we are seeing today. We got some comments out from St. Louis Fed President James Bullard, pretty hawkish comments saying that the Fed still has a ways to go. How are you looking at that, and what does this mean here for equities down the road?
Yeah, great to be back. I agree that there is some ways to go when it comes to monetary policy. Certainly last week's CPI number is the step in the right direction. But when you think about what the goal of monetary policy is, which at the minimum is to create a positive real return, we are still quite far from that. And so while we can cheer a little bit from last week's data point, I don't think the bear market is over. And I do think the Fed will have to continue to raise rates until, again, that positive real return is generated, at least on the short end. So we do expect more rate hikes going into at least the first half of 2023.
And are you surprised at the market reaction, given the fact that the Fed has continuously said it's going to stay the course and isn't going to be taking its foot off the gas anytime soon?
Yeah, last week's rally, to your point, was a bit of a surprise to us. I think, investors have a right to cheer that we are probably, when it comes to the terminal rate, we're not looking at 7 or 8%. Maybe it's somewhere between 5 and 6%. And that is a good aspect to be cheering about. But I think the reaction that we saw, in our opinion, seems to be a bit of an overreaction. And we are still, again, digesting a lot of companies still facing, whether it's labor costs, transport costs, you name it, supply chain issues. And so we're still quite cautious as we're now digesting Q3 earnings, as well as looking forward to what companies will have to say about 2023 earnings. And we think that is likely to be another clearing event before we get more bullish or more positive on the market from a sustainable perspective.
Amy, you mentioned more rate hikes again. I guess the big question is here, the size of the rate hikes. How aggressive do you think the Fed needs to be at this point?
I think they do need to have some time to let the past 4 75 basis point rate hikes make its way into the economy. We have started to see that the housing market is feeling that impact, but other parts of the market have not yet felt the impact. So I do think paring that back to maybe 50 basis points for December makes sense. I do not think, though, that they should be stopping in the sense that they should not be signaling that they will reverse course, perhaps 50 and then simmering down to a 25 basis point hike for 1 or 2, 3 more months into 2023 may make sense for us. But again, all of that depends on the data. The Fed continues to be a data dependent entity, and so are we. And we continue to feel that 1 or 2 data points is not quite enough to really map out monetary policy going forward.
And Amy, one of those data points was retail sales that came in better than expected. But then you also have a lot of consumers piling on a lot more debt. So how should we really be viewing the state of the consumer right now? How healthy are they right now?
We still think the U.S. consumer is in decent shape. We track the amount of excess savings that are still sitting on household balance sheets, and that's still, quite north of that $3 trillion level, which is a plus. However, digging into that number, we are seeing that the lower income earners, and we assume those folks also have less assets, they're probably using up or have used up their portion of savings already. And so it's starting to look a little lopsided to us. We are tracking that credit card usage and debt, to your point, is moving higher. And credit card usage is one of those metrics we're looking at. And we're not as concerned because delinquency rates are not moving up. And we are also recognizing that in a post-COVID world, or even in general, there is this long-term trend that consumers are using more card to purchase, but that doesn't necessarily translate to, again, U.S. household balance sheets deteriorating. So we think it's still decent, but we're watching it quite carefully.
Amy, you mentioned before downward revisions to 2023 earnings, just in terms of what that looks like. Drilling down into that a bit further, I guess, how much more of a decline do you expect to see compared to current estimates today?
Sure. I think, a couple of months ago, or a quarter ago, let's call it, we were looking at estimates at around $240 per share, and this is using the S&P 500 as a proxy here. As of today, we're seeing that the buy side has moved down to about $230 $1.30, which still translates to a year-over-year growth rate of 5, maybe 5.5% from 2022 to 2023. We think that's probably going to have to come down a little bit more, and we're expecting maybe it comes down to the low 200s. Of course, though, we do need to wait for management teams to guide us on that. And really, we've only heard a small handful of companies give us 2023 guidance. And so the bulk of that guidance will come in January when they report full year numbers.
And what are you going to be looking for in those earnings for 2023, especially given that 90% of the S&P has already reported now for Q3?
Sure. You're right. 90% has already reported. And I think the earnings season was okay. It wasn't, terrible in any sense. And I think the earnings surprise upside, if you would, or the growth rate as we saw it from last year this time was about 4, maybe 5%. So it's decent. And when we're looking into the next quarter's earnings, which we think would be critical as we're looking into the full year 2023, we're really looking for how capable are these companies in managing the expenses. What we're seeing is that there's probably more growth at the top line level, the sales levels, but it's not translating to earnings growth because companies are still faced with labor costs and transport costs and a lot of other expenses. And we're, again, watching how capable they are or how flexible they can in terms of managing the expenses to hopefully translate those sales into decent earnings. But again, we'll have to see until next quarter for some more guidance.